Welcome to AUSTRAC's Reporting Entity Forum. My name is Steph, and I'm a specialist in the Industry Education and Outreach team here at AUSTRAC. And joining me today is Asim, also from the Industry Education and Outreach team, River, Manager of the Foreign Banks Regulatory Operations team, Margot, Manager of the Domestic Banks Regulatory Operations team, Bryony, Director of the Domestic Banks Regulatory Operations team, and Josh, Manager in our Enforcement team. And then we also have Emma, who's the Manager of the Industry Education and Outreach team, who will be assisting with moderation today and then helping with the Q&A at the end. So I'd like to begin today by acknowledging the traditional custodians of country throughout Australia and their continuing connection to land, sea and community. I pay my respects to elders past and present, and of course extend that respect to all Aboriginal and Torres Strait Islander peoples joining us today. Thank you to everyone for taking the time to join us today. The purpose of today's forum is to help you improve your AML-CTF compliance by providing sector-specific insights, addressing common challenges, and offering practical guidance. But selfishly, today is also a valuable opportunity for us to hear from you. Your questions and feedback help us understand the issues that matter most to your sector and influence how we can support you going forward. Before we dive in though, we do have a few housekeeping items to address. So while this webinar is designed to highlight some key regulatory insights that may be relevant to your business, it does not constitute legal advice. So should you need to do so, we do encourage you to obtain your own independent professional advice that's specific to your business and individual needs. This webinar should not replace or form part of your AML-CTF Staff Risk Awareness Training Program. As mentioned, we will have an opportunity for Q&A at the end of the session, and we ask that you please submit any questions you have relating to today's content using the Q&A chat function. And just a reminder, you can submit these at any stage throughout the webinar, and we'll do our best to address as many questions as possible during the Q&A session at the end. And then finally, while we will be providing a brief update on the upcoming reforms, please keep in mind that this is not the focus of today's webinar, and we may not be able to answer detailed questions on those topics. AML-CTF rules and associated guidance are still in development, and AUSTRAC will provide education on those as details become available. Now, in today's session, we will explore several topics, including that brief update on the upcoming AML-CTF reforms, AUSTRAC's regulatory priorities, insights from the regulatory supervision team, an update from our enforcement team, insight into how your transaction reports contribute to our intelligence findings, a look at the 2024 compliance report data, and then finally, as mentioned, we'll finish with that Q&A. Now, before I hand over to Asim, I'd like to ask you to take a moment to think about why you are here and what you would like to take away from today's session. I encourage you, when you're listening to each speaker, to think about whether your business is meeting AUSTRAC's expectations in these areas. If yes, are there still areas you can improve? And if your business isn't meeting AUSTRAC's expectations, what are you going to improve your AML-CTF processes when you leave today? Now, with all that being said, to kick off today's session, we'll go into that brief update on the AML-CTF reforms, what it means for you, and what's coming next. To do that, I'll hand over to Asim.
Thank you, Steph, and good morning, everyone. As I'm sure you are all aware, Australia's anti-money laundering and counter-terrorism financing, otherwise known as AML-CTF regime, is undergoing reforms. These reforms are indicative of the Australian government's commitment to protecting the integrity of the Australian financial system and improving our AML-CTF regime. To this end, the AML-CTF Amendment Bill was passed in November 2024, amending the AML-CTF Act and progressing the simplification and modernization of the AML-CTF Act, regulations, and rules. One key objective of the reforms is to expand regulation to tranche 2 entities. These include lawyers, accountants, and trust and company service providers, dealers in precious metals and stones, and real estate professionals. Services provided by these sectors are recognized globally as high risk for exploitation, but are not captured under the current AML/CTF regime. For existing reporting entities such as yourselves, the reforms also aim to increase flexibility, reduce regulatory burden, and improve clarity by making key terms, obligations, and terminology more consistent across the AML/CTF Act and rules. This simplified framework is designed to help you better understand your obligations and strengthen ability to detect and prevent financial crime. The reforms also aim to modernize the regime so it remain fit for purpose in a rapidly changing financial environment. These reforms expand the risk-based approach, allowing flexibility as businesses continue to evolve. As part of this process, AML/CTF program requirements are set to change, moving away from a ticker box compliance. The reforms will also better define the roles and responsibilities of reporting entities, governing body, and AML/CTF compliance officer, further supporting strong oversight and suitability. The Financial Action Task Force, known as the FATF, is the global money laundering, terrorist, and proliferation financing watchdog. Influenced by the FATF, global AML/CTF regulation is inherently risk-based. Their first recommendation is to identify, assess, and understand risk. Almost all AML/CTF obligations flow from this. As mentioned earlier, the updated requirements will place a much stronger emphasis on the need for meaningful risk-based controls. One of the key changes is the introduction of proliferation financing. Proliferation financing is when a person makes an asset available, provides a financial service, or conducts a financial transaction that is intended to facilitate the proliferation of weapons of mass destruction, regardless of whether the activity occurs or is attempted. While some of you may already have been considering your proliferation financing risks, the reforms now expressly requires this. It will now also be expressly required that reporting entities assess their money laundering, terrorism financing, and proliferation financing risk as part of the AML/CTF program. While you may already be doing this in practice, this change formalizes that expectation and reinforces that your risk assessment must be the foundation of your AML/CTF compliance program. There are other structural changes to the AML/CTF program under the reforms, such as moving away from having a Part A and Part B program and a requirement for you to create and maintain appropriate AML/CTF policies to manage and mitigate the specific risks identified in your business. Beyond the content and structure of your AML/CTF program, the reforms also address practical elements such as strengthening governance frameworks. The reforms will require you to have a governing body, senior management, an AML/CTF compliance officer, and the legislation will clearly define these roles. The governing body and senior management will be required to provide ongoing, effective oversight of the business's AML/CTF compliance and risk management activities. And while the obligation to have an AML/CTF compliance officer is not new, the reforms place a stronger emphasis on the suitability of individuals in these roles. This will mean that the person appointed to this role must meet specific fit and proper requirements to ensure they have necessary expertise, integrity, and seniority to fulfill their responsibilities effectively. More information on the AML/CTF compliance officer will determine through ongoing consultation of the rules. You may also see in the amendment bill that independent reviews or evaluations will be required to be conducted at least 3 years. This does not mean 3 years will be appropriate for all businesses. The frequency with which evaluations must be conducted must still be appropriate to the nature, size, and complexity of the business. The rules will also clarify the requirements around the conduct of independent reviews. Finally, a core objective of the reforms is ensuring obligations are clear and reflect contemporary business. This is particularly evident in a number of targeted changes covering obligations like customer due diligence, international value transfer service reports, value transfer chains, and tipping off. To summarize, you will have seen this clarity achieved in the reforms to the tipping off offense, which came into effect on 31st March this year. The changes now focus on whether disclosing information would or could reasonably be expected to prejudice an investigation. This new harm prevention approach shifts the focus from compliance to risk and reduces unintended compliance challenges or regulatory burdens. There will also be changes to customer due diligence requirements to ensure a more targeted and flexible approach, focusing on outcomes that help mitigate risks associated with high-risk customers and transactions. The reforms clarify and simplify customer due diligence obligations, reinforcing that customer due diligence is an ongoing process. These changes will also clarify the level of checks applied to each customer initially and on an ongoing basis. They outline expectations around customer risk rating, initial customer due diligence, ongoing customer due diligence, and enhanced customer due diligence, or ECDD. International value service reports will replace the current international funds transfer instruction reports, otherwise known as IFTIs. The reporting obligation will now lie with the reporting entity closest to the Australian customer, better reflecting how these businesses function in practice. That brings us to the end of the reform update. For now, I'll hand over to Steph, who will take us through AUSTRAC's current regulatory priorities and how they shape our engagement with industry.
Thanks, Asim. Now, while the reforms provide insight into the future of the regime, our day-to-day work is guided by the risks and issues we're seeing across the reporting entity population now. These priorities shape how we engage with industry, where we focus our supervisory efforts, and how we support reporting entities to strengthen their compliance. In 2023, AUSTRAC published our regulatory priorities for the first time, outlining our focus areas for strengthening Australia's financial system's resilience to money laundering, terrorism financing, and other serious crime. These priorities are structured around 5 key themes. The first is our enduring priorities, which include core areas of compliance, such as AML-CTF programs, MLTF risk assessments, reporting obligations, and high-risk sectors. The second is increased regulatory focus on emerging and high-growth sectors, and this currently applies to the digital currency exchange, or virtual assets, payment platforms, bullion, and non-bank lenders and financiers. The third priority is serious and systemic deficiencies. This theme relates to compliance failures in key areas, including board and executive accountability, transaction monitoring programs, and the outsourcing of AML-CTF functions. The fourth priority is continuous improvement, which will modernise and improve Australia's AML-CTF regime. And the Australian government has reiterated this through the legislative reforms. And then finally, the final priority is partnerships, building and maturing strong relationships with a wide range of partners across industry, government, and law enforcement to support our regulatory objectives. Now, these regulatory priorities aren't just high-level goals, they directly influence the way AUSTRAC approaches supervision. They help shape our engagement with industry, inform where we focus our attention, and guide how we assess and respond to compliance behaviours. To provide more insight into how these priorities have been implemented, I'll first hand over to Bryony, Director of the Domestic Bank's Regulatory Operations team, who will share some of their team's recent supervisory work, key observations, and areas of focus going forward.
Thanks, Steph, and good morning, everyone. As Steph mentioned, my name is Bryony and I'm the Director of AUSTRAC's Domestic Bank Regulatory Supervision team. I'm joined today by River and Margot. I'm here today to provide you with an overview of the regulatory activities AUSTRAC has conducted within the domestic and foreign bank sector over the past 2 years. We will also share common issues and main takeaways that were identified from these activities across both domestic and retail foreign banks. Finally, to wrap up, I will go over some key areas the teams will be focusing on over the next 12 months. But let's start with our regulatory activities over the last 2 years. Our teams conducted several supervisory activities within the banking sectors. These focused on various obligations relating to AML/CTF compliance and risk management. I'll start the discussion on our engagement with the domestic banking sector, which can be broadly categorised into the following 2 areas. Firstly, our supervisory activities focused on transaction monitoring obligations, or TMP, and its remediation. Our activities for the last several years have included compliance assessments specifically focused on TMP obligations. We have also closely monitored the progress of remedial uplift work that's been undertaken on these activities following our assessments. We have also tracked the progress of remedial uplift projects and activities initiated in response to our previous findings related to applicable customer identification procedures, or ACIP, and enhanced customer due diligence, or ECDD, obligations. Secondly, our teams also led intensive engagement with the larger domestic banks. Our engagement with these larger banks involved semi-annual meetings to discuss the enhancement of their AML/CTF program and frameworks, technology uplift, key controls, TM programs, and other key elements of the frameworks. We also received quarterly reporting on remediation work in response to previous compliance assessments and self-identified matters. Our aim through these engagements is to ensure robust AML/CTF frameworks are in place to effectively address the risks faced by the Australian banking sector. Now we'll move on to our engagement with the foreign banking sector. In this sector over the last 12 months, our engagement included on-site compliance assessments and engagements with some of the global banks with a primary focus on MLTF risk assessment, ACIP, ECDD, and TMP. Ultimately, our supervisory activities within the foreign banking sector aim to ensure that reporting entities maintain robust AML/CTF frameworks and adhere to their regulatory obligations within Australia's AML/CTF regime. Now I'm going to hand over to River to take you through some specific feedback. But as the team shares this information with you, I encourage you all to consider the systems and controls that you have in place and the actions that you can take to ensure that you're meeting your AML obligations.
Thank you, Bryony, and good morning, everyone. I'd like to share with you some areas of improvement we have identified through our supervisory activities. Much of this feedback applies to both domestic and foreign banks, large and small. Now, whilst not all of my comments will apply to all banks, as Bryony said, as I share this information with you, I encourage you to consider the processes and systems that you have and what actions you could take to meet your obligations. The first key area for improvement relates to weaknesses in AML/CTF program. We have identified several recurring AML/CTF program weaknesses. These are crucial areas for you to consider when reviewing and strengthening your business compliance frameworks. The first weakness is a lack of tailoring of the AML program to the specifics of the individual bank. We have observed that AML programs are often not tailored and do not appropriately consider or assess the specific AML/CTF risk faced by the banks. We have also reviewed some AML programs that include generic or template controls that are not effective in mitigating the MLTF risk faced by the business. Additionally, we have also observed reporting entities placing reliance on global AML programs that are not sufficiently tailored to the Australian context and regulatory requirements. Here, we would like to emphasize the need to tailor your global AML programs to Australia. We're still finding cases of foreign banks failing to include all aspects of Australia's AML requirements, such as the need to assess a customer's source of wealth and source of funds as part of assessing customer risk. This creates significant gaps in our defences in Australia to harden the financial sector against criminal abuse. Outsourcing of obligations continues to be a point of weakness. It is critical that you ensure outsource arrangements operate at a comparable level of AML compliance within the broader corporate group and meet AUSTRAC expectations. Here, we would like to emphasise the need to ensure outsource arrangements are appropriate and meeting the Australian needs. We're still finding cases where offshore providers for TMP and ECDD are not properly trained in the specific Australian requirements, and the Australian-based AML staff do not have adequate visibility and oversight of what these outsourced functions. It is also important to remember when outsourcing AML CDF functions to a third-party provider that the legal liability remains with you as the reporting entity. You can read more about AUSTRAC expectations for outsourcing arrangements on our website. It is important to remember that there is no one-size-fits-all AML program. Each reporting entity is different and has its own unique set of MLTF risk. Your program must be tailored to meet your specific needs, risk, and characteristics. This gives you the flexibility to decide how to meet your obligations and develop stronger or additional controls where necessary. Your AML program must be risk-based. This means that you must consider the likely level of risk that your business or organization may be used for money laundering and terrorism financing, based on your size, nature, and complexity, taking into account the 4 pillars: who your customers are, the designated services you provide, how you deliver those services, and the foreign jurisdictions in which you deal with. We recommend that you review the AML program guidance on the AUSTRAC website to ensure that your AML program is appropriately tailored to your business model. The absence of a purpose-built AML program is not only a breach of your AML obligations, it also creates significant operational risk and can lead to increased vulnerability to criminal threats. You need to ensure that you accurately know who your high-risk customers are. We're still seeing some instances of entities providing multiple competing figures in relation to their high-risk customer cohort. There should be a single source of truth for this important customer segment. This will assist you in managing your customer risk. I'll now hand over to Margot to discuss our observations around transaction monitoring program.
Thank you, River, and good morning to all. I would like to address some of the weaknesses we have observed in transaction monitoring programs, or TMPs. Our recent assessments and engagements with the banks have highlighted several common key weaknesses within current TMPs that require uplift. Our TMP reviews cover both design and operational aspects of TMPs. In terms of design, we find that reporting entities have not necessarily given consideration to the full range of MLTF risks they may face, and there is often a lack of ongoing calibration or tuning of rules. Banks may not be fully leveraging available guidance provided by AUSTRAC and other regulatory and industry bodies to inform their transaction monitoring rules, potentially leaving them vulnerable to certain types of illicit activity. In addition, the absence of a robust and ongoing enterprise-wide risk assessment process may lead to an underperforming TMP. Banks need to identify on an ongoing basis the risks that need to be monitored under their TMP. Banks need to remain mindful that new products and channels may bring new risks which need to be considered within your TMP. We continue to observe poor TMP design where banks do not always incorporate evolving and sophisticated risks within their TM rule set within a reasonable timeframe. Although we recognize it is a complex process to review new typologies and red flags against existing rules to determine whether your existing TM rules cover these risks or you need to modify or create new rules, the expectation is that this is undertaken in a timely manner. Otherwise, this may leave banks ill-equipped to detect the more complex and emerging typologies of suspicious activities that we are seeing today. We have found that reporting entities are not always implementing appropriate and effective systems and controls to identify and mitigate their MLTF risks. In addition, data quality and change management are critical to a robust TMP. Changes to systems must consider the upstream and downstream impacts on any TMP, in order to maintain the integrity of data flows and the application of the TM rules across the bank's transactions. Finally, we identified that reporting entities are not effectively training their operational staff on how to adequately perform TMP reviews, nor applying robust QA and QC processes to their TMP. As a consequence, too many red flags are overlooked. This is an issue whether the TM analysts are based in Australia or overseas. However, additional training is required for international analysts to understand typical and atypical Australian transactional behaviour. In terms of domestic staff, it is vital that branch staff remain attuned to unusual behaviour, which could include excessive cash transactions, structuring transactions, or coercive control behaviour, which could include the elderly, persons with limited language skills, or any indication of domestic control. We continue to see a high level of TTRs that are not converting to SMRs, and this suggests that some frontline staff may have come to normalise high cash behaviour. Branch staff continue to play a key role in identifying suspicious behaviour. Training is key. A lack of adequate training could lead to inconsistencies between analysts in alert handling, missed suspicious activity, or an absence of a clear rationale for the determination of whether or not the behaviour was deemed suspicious. SMRs continue to be submitted with a weak grounds for suspicion section that may not reflect all of the information gathered during the investigation process, including any customer outreach that led the analyst to determine the behaviour was suspicious, and any footage that may add additional intel value. The SMR should be reviewed objectively and holistically before submission to ensure that the grounds for suspicion clearly states upfront what is the key suspicion trigger, not simply a list of recent transactions in response to a legal notice. Timing is also critical, and banks need to work on the trade-off between reporting the suspicion as soon as possible and gathering the information together. Remember, SMRs aid in combating crime. All of the factors I have listed are indicative of an overall weakening of your first line of defence in transaction monitoring. As mentioned previously, TMPs are a current regulatory priority for AUSTRAC. A TMP is key to the effectiveness of your AML/CTF compliance because it helps your bank to identify, mitigate, and manage ML and TF risks, identify and report suspicious matters to AUSTRAC in a robust SMR with strong intel value, and meet your OCDD and ECDD obligations. There are key things that you should be aware of when it comes to your TMP. These include: you must document how you monitor customer transactions in your AML/CTF program. Your TMP must be based on the risk assessment of your business, and you must define the processes you follow as to identify suspicious customer transactions. You should allocate appropriate resources and give priority to analysing and actioning alerts raised by transaction monitoring. You need a strong QA and QC process in place to ensure the quality of the investigation and SMRs. Your business must have an appropriate risk-based TMP to help your employees identify suspicious behaviours and transactions, and to take steps to protect your business and customers. AUSTRAC expects that you have a clear and documented process within your AML/CTF program to ensure a consistent and structured approach to the review of TMP alerts. This includes, but isn't limited to, service level agreements for the investigation of alerts and the nature of the inquiries made in relation to each specific alert. As I said earlier, AUSTRAC also expects that entities regularly review their TMP and update these where appropriate to adapt to any emerging risks and effectively calibrate the alerts with new typologies and regulatory changes. Proactive adaptation is key to maintaining an effective TMP. For example, over the past decade, we have seen child exploitation risks broaden from traditional child exploitation material to sextortion and self-produced material by minors. All three risks bear distinct red flags. In the current environment, you may also wish to consider what risks may be emerging from the current instability in the global financial markets and update your TMP accordingly. I recommend that you visit the AUSTRAC website and review the transaction monitoring guidance to ensure that your business or organisation is best placed to alert you to unusual, large or complex transactions or patterns of transactions. AUSTRAC has published indicators of suspicious activity for the banking sector that you can use to update your TMP rules. I will now pass you back to Bryony to discuss our findings on governance and oversight.
Thanks, Margot. Our regulatory activities have also highlighted some weaknesses in board engagement and oversight across the domestic and retail banks that we see. Firstly, we've noted instances where AML-CTF compliance officers do not receive appropriate reporting and/or have appropriate oversight of all the AML-CTF functions, as well as instances where AML-CTF matters are not appropriately transferred to the relevant committees. This results in inadequate oversight by the board. This lack of robust board-level engagement and oversight can undermine the effectiveness of the entire AML-CTF framework. Our teams have also observed instances where key decisions and sometimes breaches have not been escalated appropriately to the board or senior management. This has resulted in a lack of oversight of AML-CTF matters, and in some instances, this extends to overseas boards not having oversight of local AML-CTF matters. Failures in escalation pathways can hinder timely intervention and remediation of critical AML-CTF issues. Additionally, in specific reference to international entities, banks need to ensure adequate and appropriate governance over large-scale changes occurring at the global enterprise level that impact AML-CTF activities in Australia, and ensure that these boards and senior management have consideration and oversight of local AML-CTF matters. This raises concerns about the level of oversight some boards have over AML-CTF functions, including that boards may not have defined a clear risk appetite for MLTF, that boards may have inconsistent quality and frequency of reporting, and that the AML-CTF program has not been appropriately tailored to the organisation. So what does good AML-CTF governance look like? Through effective oversight of AML-CTF compliance, boards and senior management can lead an organisation-wide positive AML-CTF culture. This includes the board and senior management engaging, questioning, challenging, taking ownership, and assuring adequate resources are allocated to address any MLTF risks that the business faces. To achieve this, AUSTRAC expects board and senior management to be appropriately trained in AML-CTF and committed to ensuring AML-CTF programs and changes are approved and adequately resourced by leadership. That senior management has clear accountabilities and prioritise risk management, ensuring that specific responsibilities are assigned and new or emerging MLTF risks are identified, monitored and addressed. That boards and senior management support timely issue resolution and have a compliance focus, where compliance and system issues are documented, escalated and fixed promptly, with a focus on preventing systemic non-compliance. We expect that boards and senior management consider change management and issue identification. So with assurance processes in place to manage changes without disrupting compliance and with mechanisms to quickly identify and resolve instances of non-compliance. Banks need to provide ongoing AML-CTF risk awareness training for staff members located in offshore hubs who fulfil elements of your AML-CTF program, such as TMP and ECDD. Such training should ensure that offshore personnel have specific training to identify what is considered typical and atypical transactional behaviour in Australia and in specific regions within Australia. Boards should maintain ongoing oversight of AML-CTF functions, including outsourcing arrangements, so that non-compliance is detected and addressed through ongoing assurance, review and oversight of AML-CTF obligations, including activities conducted by agents and outsourced providers. For example, if the bank outsources its AKIP or its TMP, the bank retains the responsibility to ensure that the provider is acting in accordance with the bank's AML/CTF program and that the quality of the activity is to the requisite standard and that the bank has controls in place to confirm that this is being met. Equally, if the bank has an agency arrangement in place for collecting cash on behalf of another reporting entity, the bank must have robust transaction monitoring and other controls in place. I'll now hand you back to River to talk about reporting obligations.
Thanks, Bryony. So we have observed a range of quality in transactional reports from our reporting entities. Some of these have been touched on by Margot earlier, but it's worth repeating here. Specifically, our analysis revealed the following areas needing attention. We have observed reporting weakness in all report types, particularly in terms of quality of information captured and or reported to AUSTRAC. This includes issues with the completeness, accuracy, and level of detail provided in these crucial reports, which can hinder the effectiveness of our intelligence gathering. We are finding instances of both under and over reporting of SMRs within the banking sector. Specifically for foreign bank branches, we have identified limited reporting of SMRs from the subsector. Banks are obligated to report on suspicious behavior, including recurring behavior. However, banks should take into consideration if there's any new information or intelligence value added when submitting SMRs. Also a significant concern is the reliance on manual controls, which are prone to human error. This reliance increases the risk of mistakes in identifying, capturing, and reporting suspicious or significant transactions. Banks should endeavor to ensure that TM alerts for the same customer are reviewed by different analysts to bring fresh eyes to the investigation. We have also identified insufficient change management, which negatively impacts reporting. Inadequate processes of managing system or procedural changes can lead to inconsistencies and errors in reporting. Furthermore, we have identified ongoing data quality issues, especially across brands where the DBGs rely on different systems. The use of disparate systems without quality assurance processes can result in inaccurate and unreliable reporting. Finally, there is a need for enhanced quality assurance and quality control processes for SMRs. Strengthening the quality assurance and quality control measures specifically for SMRs is crucial to ensure the information received is accurate and actionable. Australia's banks provide critical intelligence through the reports they submit. Ensuring your reports are submitted according to timeframes and including all the required information is essential to ensuring AUSTRAC, law enforcement, and our partners have access to high-quality financial intelligence. Remember, if these must be submitted within 10 business days of the transfer instruction being sent or received. TTRs must be submitted within 10 business days after the date of the transaction. And SMRs must be submitted within 24 hours if the suspicion relates to terrorism financing, and within 3 business days if the suspicion relates to other matters such as money laundering or other serious crimes. Here I want to remind everyone that timely reporting helps AUSTRAC gather actionable intelligence to combat financial crime. As Asim touched upon earlier regarding tipping of obligations in the summary of targeting changes that came into effect on 31st of March 2025, when submitting an SMR, you must ensure that you don't tell the customer that you have formed a suspicion about their activity or that you have submitted an SMR to AUSTRAC. For example, if information was to get back to the person who may be involved in a criminal activity, one of their associates, or is publicly released, that would be considered tipping off. The AUSTRAC website has a lot of guidance on reporting obligations and provides clarity on how to ensure quality while reporting to AUSTRAC. We recommend that you review AUSTRAC's guidance on effective reporting to ensure compliance and accuracy. These guides walk you through each section of the report and specify the necessary information. I will now pass on to Margot to discuss our observations regarding scams.
Thank you. The final observation from our regulatory activities that I will share with you today relates to addressing the risk in fraud and scam-related transactions. To effectively combat this growing threat, it is crucial to ensure that your workforce is adequately sized, skilled, and supported by robust systems capable of detecting and responding to account opening and transactions that may fall outside the bank's risk tolerance. This includes having sufficient personnel with the right expertise, empowered by technology that can identify unusual patterns and anomalies indicative of fraudulent interactions or scams, particularly at the account opening stage and during transaction processing. These systems should be sophisticated enough to flag activities that deviate from established risk parameters. Noting the market for bad actors purchasing accounts for use as mule accounts, or scam victims being ensnared into acting as mules, banks should remain vigilant to any change in behaviour of customers. Such customers may have been onboarded as international students or may hold long-standing accounts that have not previously exhibited unusual activity. Any red flags should not be dismissed just because of the length of the relationship with the customer. Money mules are a major vulnerability and enable the laundering of significant amounts of criminal proceeds. We strongly recommend that you review the guidance on fraud and scams available on the AUSTRAC website. This guidance provides an overview of common scam indicators and outlines the necessary steps to take. I'll hand you back to Bryony, who will close out with a look at our future focus areas.
Thank you. So looking ahead, AUSTRAC's regulatory supervision teams will continue to ensure reporting entities across all sectors maintain risk-based and fit-for-purpose AML/CTF programs. We will monitor how businesses are adapting their programs to respond to changes in their products, services, customer base, or the risk environment, and will support improvements in the quality and relevance of MLTF risk assessments. We will also assess the effectiveness of transaction monitoring programs and the ability of entities to detect and respond to unusual or suspicious activity, as well as reviewing how entities apply enhanced customer due diligence measures and manage higher risk relationships and transactions. AUSTRAC will also maintain a strong focus on entities' governance and oversight arrangements, particularly the role of boards, senior management and AML/CTF compliance officers in ensuring programs are properly maintained and adapted to emerging risks. AUSTRAC's approach remains risk-based, intelligence-led and outcomes-focused. We encourage all reporting entities to take a proactive approach to compliance. Review your systems and controls regularly and ensure that they're fit for purpose in this rapidly evolving risk environment. By maintaining strong AML/CTF programs and engaging openly with AUSTRAC, you contribute directly to safeguarding Australia's financial system and protecting the broader community. I'd like to thank you for your attention to this section and remind you to consider this feedback in the context of your own bank and your role. I'll now hand back over to Steph to continue with today's session.
Thanks, Bryony. And thank you as well, River and Margot, for your overview of AUSTRAC's recent supervisory work and those great practical insights that you all shared. So just a reminder to our audience, if you have any questions for the regulatory team, please feel free to enter these into the Q&A. Now, while supervision plays a key role in helping reporting entities strengthen their compliance, there are times where more serious and systemic issues require a stronger response. With that in mind, we'll now hear from Josh, Manager of our enforcement team, who will provide an update on AUSTRAC's enforcement activity, key themes we're seeing in non-compliance matters, and what to expect going forward.
Thanks, Steph, and good morning, everyone. My name is Josh Barr, and I'm a manager in the AUSTRAC enforcement capability. If reporting entities do not meet their obligations under AML/CTF law, AUSTRAC can take steps to compel their compliance and/or seek a penalty. Enforcement actions are specific legal actions we can take to make sure reporting entities comply with the law. Enforcement actions available to AUSTRAC are civil penalty orders, enforceable undertakings, infringement notices, remedial directions. Another type of action AUSTRAC can take is to issue a written notice requiring a reporting entity to appoint an external auditor to review your MLTF risk management or AML/CTF compliance, or undertake an MLTF risk assessment. We can also refuse, cancel, or suspend the registration of remittance service providers and digital currency exchange providers if they pose an unacceptable risk of money laundering, terrorism financing, or other serious crime. AUSTRAC very recently refused to renew a crypto ATM operator's registration and placed operating conditions, including transaction limits, on other Australian crypto ATM providers. Over the past year, AUSTRAC has continued to use its full range of regulatory tools, including enforcement powers, where necessary, to respond to non-compliance and uphold public confidence in Australia's financial system. While we like to be transparent about our enforcement outcomes, it's important to note that not all investigations have progressed to the point of public outcome. So today, I will only speak to matters that are already in the public domain. We recognise that threats are evolving and controls won't always catch everything. But compliance failures in the AML-CTF regime can contribute to significant real-world harm. And where harm has occurred, or where the risk of harm has been materially increased by those failures, reporting entities should expect AUSTRAC to act accordingly. Recently, AUSTRAC undertook significant enforcement action against several entities for failing to comply with their obligations under the AML-CTF Act. One of the more prominent matters involved a casino operator, where enforcement action led to a substantial civil penalty. The casino operator was found to have failed to meet customer due diligence requirements and had systemic weaknesses in its risk management and controls. As a result, the federal court ordered the casino operator to pay a substantial penalty. The decision was based on findings of serious breaches of the AML-CTF Act, particularly around ongoing customer due diligence and systemic control failures. These weaknesses allowed high-risk customers to move large sums of money through the casino's operations over several years, obscuring the origin and ownership of those funds. The casino operator also provided services through high-risk channels and to high-risk customers without implementing necessary risk-based controls. As a result, they failed to conduct required checks on a significant number of customers, including individuals known to law enforcement or presenting indicators of potential money laundering risk. This outcome highlights the importance of establishing and maintaining a robust risk-based AML-CTF program, not just to avoid substantial penalties, but to protect the integrity of your operations and reputation over the long term. Looking ahead, serious and systemic non-compliance, particularly regarding foundational obligations, such as risk-based customer due diligence, will remain a focus of AUSTRAC's enforcement work. In an environment of evolving threats, we recognise that some degree of failure is inevitable. Controls won't always hold up, and we accept that. But we're still seeing, in too many cases, basic obligations not being carried out effectively or at all, and unpersuasive proof that the business is taking reasonable steps to reach compliance. It's important to remember AML-CTF is not a set and forget regime. You need to ask, how does MLTF risk actually play out in your business? Where are the real vulnerabilities? How are you monitoring whether your controls are working? And what happens when they're not? Again, the AML-CTF regime is not designed to eliminate all financial crime. It's about taking reasonable, evidence-based measures to identify, manage, and mitigate risk. That means you need to explore a tailored and proactive approach. There is no one-size-fits-all solution. While we recognise that occasional failures may occur, it is critical that when these issues are identified, they are addressed promptly. Open, proactive communication with AUSTRAC, particularly where significant compliance concerns arise, is the most effective way to mitigate broader consequences. We saw this approach in practice recently when AUSTRAC accepted an enforceable undertaking from a corporate bookmaker following an extensive supervisory assessment. The corporate bookmaker demonstrated its willingness to cooperate and proactively address its obligations. AUSTRAC determined that accepting an enforceable undertaking from the corporate bookmaker was the most appropriate regulatory response. This matter highlights the importance of collaboration, transparency, and early action in supporting compliance outcomes. In contrast, a culture which encourages avoidance or compliance window dressing will be a focus of enforcement's work. By proactively engaging with AUSTRAC and strengthening your compliance frameworks, you directly contribute to safeguarding Australia's financial environment. That brings us to the end of the enforcement update. While the nature of my day-to-day work means that some things do not end up in the broader public forum, I hope this has provided some useful insights into our enforcement focus and the importance of maintaining risk-based controls. Thank you for your time. It has been a privilege to be able to engage with you. That said, and I mean this in the nicest possible way, I hope you don't encounter me or my enforcement colleagues in future in the context of our day jobs of conducting enforcement investigations and enforcement action. With that, I'll hand back to Asim to continue with today's session.
Thanks, Josh, for that update. It's a strong reminder that while AUSTRAC understand the challenges of managing financial crime risk, there's a clear expectation that reporting entities are actively identifying, addressing, and learning from gaps in their programs. A reminder here that if you have any questions for Josh, please enter these into the Q&A. We are now going to shift our focus by taking a step back and looking at the bigger picture through the lens of AUSTRAC intelligence insights. This is where we start to see the why behind the AML-CTF regime, how criminal threats are emerging and evolving, the sectors being targets, and the behaviors that create vulnerabilities. I will share some intelligence insights and a case study to learn more about how AUSTRAC intelligence is used. Today, you have heard about your AML-CTF obligations and the weaknesses observed by our supervision and enforcement teams. You have also heard about AUSTRAC's expectations. Why does this all matter? As a reporting entity, you are at the front line in combating financial crime, and you know your customers best. So you are best placed to recognize potentially suspicious behavior or activity and report it to us. Each year, billions of dollars in illicit funds are generated from illegal activities such as drug trafficking, tax evasion, cybercrime, and other illegal and corrupt practices. As criminals seek to exploit vulnerabilities within the financial system to disguise illicit funds and enable serious criminal activity, AUSTRAC's dual role as AML-CTF regulator and financial intelligence unit helps to build resilience in the financial system and allows us to use financial intelligence and regulation to disrupt these activities. The reports that you submit makes a real difference in detecting, deterring, and disrupting criminal and terrorist activities. We analyze the reports you submit using sophisticated modeling and predictive analysis tools, cross-referencing them with reports other entities submit, as well as our own intelligence holdings, to find patterns of criminal activity, including money laundering and terrorism financing. We share this information to help our partners in Australia and overseas to investigate and fight crime. It's your information that can help launch an investigation, solve a crime, or link criminals not previously known, helping to protect the wider community. Advancements in technology allow people to do business and move money around the world more quickly and easily, but it also creates opportunities for criminals who are constantly looking for ways to take advantage of the global financial system. Almost all serious crime types have a financial component. As such, financial transaction data analysis can assist in identifying relationships between individuals and networks, the movement of funds, and patterns of activity or behaviors. From our dual regulatory and financial intelligence perspectives, the work we do has a significant impact in disrupting serious and organized crime. In practice, there are a number of opportunities available for the utilization of AUSTRAC intelligence and for us to provide support. We produce intelligence products that are used to assist in law enforcement investigations by giving investigators new and potential lines of inquiries. In addition, the AML/CTF legislation allows for the collection of further information from reporting entities or related parties in response to the reporting they have provided to us. We have intelligence analysts based in key partner agency offices around Australia to support investigations, as well as licensed officers based overseas in key locations. We also collaborate with partner agencies by participating in various law enforcement task forces and operations, where financial intelligence can be effectively utilized to identify individuals or entities of interest that are under investigation. And finally, we provide support to our regional international financial intelligence units and regulatory counterparts. This is to increase compliance with international standards, particularly through the development of the stronger AML/CTF capabilities and overall intelligence expertise. Okay, now I will share a case study to help paint a clearer picture of how reports submitted by reporting entities like yourselves provided intelligence that directly aided a real criminal investigation. Our information was used by a law enforcement agency, which led to a law enforcement investigating a syndicate that was involved in large-scale identity fraud. A bank teller submitted a SMR, suspicious matter report, to us that described over-the-counter bank transactions in which two people were involved: the account owner and the main suspect. The suspect was not connected to the account by any documentation, but controlled the transactions and would not allow the account owner to speak to any bank staff. The pair transferred approximately 541,000 Australian dollars from a bank account into Jordan to an Australian account. Then they withdrew approximately around 394,000 Australian dollars from the Australian account using a bank check. When the bank teller requested the account owner to undertake this withdrawal, the suspect became agitated and aggressive. The pair also transferred approximately 147,000 Australian dollars from the Australian account to a third-party account. These transactions left the account owner with a final account balance of 1,000 Australian dollars. This information allowed authorities to link the suspect with the movement of funds to Jordan, the United Arab Emirates, and the Peru. Law enforcement continued their investigations and ultimately commenced proceeds of crime action against the suspect and members of the syndicate. The ultimate led to the recovery of the approximate 101.6 million Australian dollars in assets, which included real estate and cash. This case study highlights the crucial role that reporting entities such as you play in supporting intelligence, outcomes, and keeping our community safe from criminal abuse. This brings us to the close of the intelligence insights and how AUSTRAC intelligence is used. As you can see, the power of data and intelligence is fundamental to how we identify emerging risks and proactively foster a stable and resilient financial sector, ensuring robust financial landscape for everyone. I will now hand over to Steph, who will take you through the rest of today's session.
Thanks so much, Asim. Now, as reporting entities, most of you are required to submit a compliance report to AUSTRAC each year, where you answer questions about how you have met your AML/CTF obligations. The information gathered from the compliance report provides key data inputs for our risk modelling of reporting entities and sectors as a whole. It helps us understand how you are tracking with your obligations, where there are areas of strength, and where some gaps may still remain. And it also helps inform how we define our regulatory priorities and tailor our engagement and support going forward. So as many of you will know, the reporting period for the 2024 compliance report only closed 31st of March, so we are still deep in that analysis. However, a few early trends have already emerged, and they align closely with the themes that we've touched on today. So to begin with, it's worth noting a positive outcome from the 2024 compliance report period, with 84% of all reporting entities with that compliance report obligation completing their 2024 report, which is up from 82% last year. Again, it's encouraging to see an increase in engagement across the whole reporting entity population. As mentioned, the data you provide gives us vital insights into how the regime is working and helps us shape guidance, identify any gaps, and tailor our support to where it's needed most. Ultimately, the more complete and accurate data we receive, the better place we are to help you meet your obligations and protect your businesses from risk. Now, moving on to risk assessments, you can see some responses from the banking sector on the screen. While it's also encouraging to see that 91% of reporting entities in the banking sector reviewed or updated their MLTF risk assessment in 2024, only 15% of those indicated that they did so in response to AUSTRAC engagement, guidance, or feedback. Now, while we acknowledge that not every AUSTRAC engagement will require a full reassessment of your risk profile, this number suggests that many entities may be missing opportunities to adapt their programs in response to regulatory or environmental change. For example, AUSTRAC published national risk assessments on money laundering and terrorism financing this past year. These risk assessments should be used by entities to review and update their risk assessment. AUSTRAC also presented sector-specific webinars to communicate the findings of these risk assessments at the time, and you can still find the recordings of these sessions on our AUSTRAC YouTube channel. Now, moving on to enhanced customer due diligence. As you recall from earlier, ECDD is required in a range of high-risk scenarios. However, we continue to see evidence of inconsistent application of ECDD controls, particularly around senior management oversight. Of the 96% of reporting entities in the banking sector who reported conducting ECDD in 2024, 73% stated that they sought senior management approval to provide a designated service, and 88% stated that they sought senior management approval to continue with high-risk customer relationships. Now, these figures are encouraging and suggest that banks have effective escalation protocols. However, I encourage you to take into account what regulatory operations team said earlier. Are you answering your compliance report questions accurately? Supervision insights have suggested that escalation protocols may not be working effectively, or that decision-making is not being documented in line with your obligations. Now, when it comes to reporting obligations, we know that timely, accurate reports are one of the most valuable contributions entities can make to the broader AML/CTF regime. Compliance report responses continue to show variability in how obligations are being met, particularly around the systems and controls that support detection and escalation. This has a flow-on effect to the governance and oversight of your frameworks. For example, only 30% of reporting entities in the banking sector that confirm that they do outsource one or more of their AML/CTF obligations said that they provide reporting to their board or senior management on the performance of those outsourced functions. Given that outsourcing is relatively common, with 61% of all reporting entities stating that they outsource one or more of their compliance functions, this highlights the need for stronger governance around outsource arrangements to ensure oversight and accountability remains in-house. Now finally, let's talk about transaction monitoring. The data currently shows that 50% of all reporting entities identified suspicious activity via staff, while 37% identified it through their transaction monitoring program. This alone tells us there's room to improve program effectiveness, but what's particularly important to highlight is of all reporting entities, those that reviewed their TMP over the past year were more than twice as likely to detect suspicious activity, with 48% of those who had reviewed their TMP making a detection, compared to just 22% of those who had not. And this reinforces a critical point. Much like your AML/CTF program as a whole, your transaction monitoring program is not set and forget. Ongoing tuning, testing, and adaptation are essential to ensuring that TMPs remain aligned with your risk profile and capable to detect suspicious activity in real time. Altogether, these insights help us see where improvement is happening and where there's still work to do. And the data reflects many of the themes we spoke about earlier: the need for tailored risk assessments, consistent application of customer due diligence, clear governance, and effective systems and controls. But we will continue to use this data to inform our regulatory focus and support activities, and we encourage you to reflect on how these insights might apply to your own program and practices. Now, with all that, that brings us to the end of today's forum. Again, thank you all for joining us today, and I hope you found this session extremely valuable. But otherwise, I'll hand it over to Emma.
Great. Thank you, Steph.